Hello everyone. Welcome to Demand Supply Trading Practical Session number 45 for the year 2025. Myself Srijit Kakkar, and today is Sunday 23rd of November 2025. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on Telegram where we keep updating you with content related to demand supply trading methodology. Plus, if we have any offers or promotions coming up, that is where we update you. And that's the first point where you'll get to know what those offers and promotions can be. And last but not the least, when we talk about these live practical sessions, that is where we update you when these sessions are scheduled so that you can plan your day accordingly in case you want to join these sessions live. Now, once you okay, now let me also add. Now, when it comes to joining this Telegram channel, there are a few different ways you can do it. The first way is you can scan the QR code which is on your screen. Second, you can go to the description of this video and you will be able to find the direct link to the Telegram channel. And third, if you visit our website, which is surjitkakkar.com, or you can use the short URL, which is sk.coach. So just give me a second, I'll quickly show you. Perfect. So once you visit our website, you can just scroll down on any of the pages, and at the footer section, you'll be able to find this banner which says join Telegram channel, and in front of it, you have this join now button. You can click on this and you can join the Telegram channel. So these are a few different ways how you can be part of the Telegram channel to be always updated. And also, if you are interested with content related to demand supply trading methodology, that is also what we keep updating you in that channel about. All right, so today's session is practical application of demand supply trading methodology. So our demand supply course is now available as a 100% free course, which includes both the theory as well as the practical sessions. So how do you access the theory? We'll talk about it as we move forward in the session. But along with the theory, you also need to have the practical understanding of how to apply the methodology, and that is what we do in these practical sessions. Now, another advantage of these practical sessions is one, and that these are live sessions. So at the end of the session, if you have any questions, queries related to trading or even to demand supply trading methodology, you can always put it in the chat box. At the end of the session, I'll answer your questions, queries. And two, when you see how to apply the process in a very mechanical way, you get a better understanding of how to use demand supply. Now, the best part about demand supply trading methodology is that it is also called as set and forget methodology. So in a way, when we do our analysis in these sessions, we are not reviewing something which has already happened, because like I always say, a move which has already happened, it's very easy to justify it. You can use a number of indicators, oscillators, price action to justify that move. But the real challenge is when you have to do the analysis well in advance, and that is what we do in these sessions. So in these sessions, when we analyze some of these symbols, we are not analyzing what has already happened. We are analyzing what might happen in the future. So we are planning our demand and supply zones well in advance. And sometime in the future, when prices, they revisit those areas of demand and supply, that is the time those trades, they get triggered. And just because I'm sharing this analysis in advance, does not mean that I share this analysis and then we forget about it. Whatever analysis I share with you, whenever in the future they get triggered, we also review them, and that helps you see the both the before as well as the after. And when you start seeing the both before as well as the after, you start gaining more confidence in the methodology, because nothing can be more transparent than planning the trades even before the moves they happen, right? So that is what we do in these sessions. All right, now to be comfortable with these sessions, there are few prerequisites, and completing these prerequisites will make these sessions much more easier on you. So let's talk about what these prerequisites are. The first one is the Trading Essentials course. Now, how do you access the Trading Essentials course? Now, again, it says optional. Optional, why? Because someone who already has been trading for a number of years or a number of months, and they have a very good trading background, in case they wish to skip it, they can. So I would highly recommend, irrespective what your trading background is, always start with the Trading Essentials course. Now, how do you access the Trading Essentials course? Very simple. Once you visit our website, under services, you can see you have this option which says courses. Click on it. And here you can see the very first one is Trading Essentials. Click on Trading Essentials. The course is available in two languages, English and Hindi. So when you will click on it, it will take you to the course page where all the lessons are laid out for you. Just go through all the lessons, and completing those lessons basically covers your Trading Essentials course. Now, once you're done with the Trading Essentials course, we will move on to the next prerequisite, which is your demand supply trading course. Now, how do you access the demand supply trading course? Exactly the same process. Under services, go to courses. And here you can see the second one is demand supply trading. Now, this is also available in two languages, English and Hindi. So whatever language you're comfortable with, just click on that button. You'll get immediate access. No signups required, no registration required. You'll get the access to the course content, go through all the lessons, and that basically covers your demand supply trading course. Now, when you go through the course, like I said, you will be learning the methodology theoretically, but to have a better understanding, we also need to have the practical application. We also need to cover the practical application side of it. And that is what I do in these practical sessions. So almost every weekend, I do a practical session where we apply whatever we learned theoretically to some practical examples so that we can understand how to use the methodology and how to plan trades using demand and supply. Now, what I also do is that all these practical sessions, they are also recorded and archived for you, because in one single practical session, we can't cover all the rules that we learn in the demand supply trading methodology. Plus, what also happens is that when you're learning something theoretically, all examples are textbook examples. But when you go to real life situations, there are variations, right? So that is why every weekend I do a practical session where we look into different variations, and all these sessions are recorded. So if you want to watch the recordings of the previous session, you can click on the practical sessions. And these recordings are also available in two languages, English and Hindi. Currently, the archive is getting close to 2 years of recording. So you have a lot of content available to you. Watch as many sessions as you wish to, because the more number of practical sessions you will see, the better you'll start having the understanding of the methodology and how to apply it. So that's your first two prerequisites. Now, during the live sessions, these practical sessions, you will also see that when I do the analysis, I use two documents. One is the rule book, the other one is the flowchart, to help me plan trades very mechanically and rule based. Now, how do I access these two documents? Let's also talk about it. So again, under services, you will go to the download section, and here you can see you have your rule book and the flowchart. So this is your rule book and this is your flowchart. Now, how do we use these documents? Like I said, during the practical session, you'll experience it and you'll understand it better. Now, what we always do is that whenever we start the session, if any of the trades or any of the examples that I shared with you in the past, they got triggered, or if any one of them is getting carried forward, we start with a review of it. But whatever got triggered in the past has already been reviewed, and during the week, nothing new was triggered. So we don't have anything pending for review. We can straight away start with our analysis for today. So again, when it comes to trading, I always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video. The title of that video is How to Start Trading. The link will be available in the description. So in case you have not yet watched that video, do ensure you watch it, because there is no bypassing it. Eventually, everyone will have to go through that process. So the sooner you start, the better it is going to be for you. Plus, a very common question I get is that, when I'm planning trades, I'm making my decisions based on emotion. So how do I shift from an emotion decision-making process to a mechanical decision-making process? And that is where this video, which is How to Start Trading, also helps you understand how you should be starting with your trades. And like I already said, once you go through that process, maybe twice, maybe thrice, you will by default start realizing that you are now planning your trades more based on your rules and less based on your emotions. So it's a very, very important step which everyone will have to go through. So the sooner you start, the better it is going to be for you. So do watch that video. The link should be available in the description. So since we need to be mechanical and rule based, what we need to do is we need to create something which is called as a trade plan. Now, the challenge is, if you have just started learning how to trade, right? Or if you have started learning a new methodology, it's not very easy to create a trade plan from day one. To create a trade plan, first you need to have a good understanding of that particular methodology. And if you have a good understanding of that methodology, then yes, you can definitely convert it into a trade plan. So to overcome this challenge, what I've done is I have created two documents for you. The first one is the trade plan steps. You can also call it as the walkthrough or the flow chart. Now, this document basically tells us step by step what we need to do as a demand and supply trader. Now, all these steps, they have their own elaborate rules, and those rules are available in the rule book. Now, minded, this rule book that I've created for you, this is a conservative rule book, because when we start learning something new, it definitely makes sense to be a little conservative. But as you start having more and more experience, you start gaining confidence in your analysis. If you want to make some modifications to that, rule book to maybe make it more aggressive, make it super aggressive, make it extra conservative. Those modifications can be done based on your personality style. So what is my step number one whenever we start planning our trade? Step one is we need to define our trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade. And the duration is from the time you enter the trade to the time you exit the trade. And now when I'm talking about the exit here, the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit, right? So exit, I just don't mean profit exit. Exit can be in profit, exit can be break even, exit can also be in loss, any kind of exit. So now the question is, why are we starting with our trade purpose as our very first step? The reason we are doing this is because when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So out of these a number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We again go with a very logical approach. And that logical approach is that the longer I want to be in the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration of the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, very important, by definition, I said daily income is a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets, so let's take example of NSE India, which is not a 24-hour markets. So I'm pretty sure that you people who are trading such markets, you would have realized that whenever the market opens, some symbols they gap up and some symbols they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight in a market that is not a 24-hour market, we have that added gap risk involved in that particular trade, which cannot be avoided. So that is why my recommendation to all of you is that initially your hourlies and dailies will be strictly intraday trades. You will not keep them as overnight trades and take that unnecessary overnight gap risk. Now, when it comes to weeklies and monthlies, anyhow, we are not expecting to get the exit the same day. These are the trades which can last for a few weeks or maybe even few months. So here you have no choice. You'll have to keep these positions as overnight positions. But that does not mean that for weekly, monthlies, you cannot have a gap against you. It can still happen. But since you're leaning against some bigger time frames, the probability definitely reduces, right? So the probability definitely goes down, but remember, it can still happen. But as you start having more and more experience, you start building up confidence in your analysis. If you want to include daily incomes into overnight trades, that can definitely be done, because like I said, by definition, daily income implies a trade which can last for a day or few days. So my step one is I need to define my trade purpose, and let's assume I opted, I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if I go to page number 28 on the rule book, we start with the topic which is multiple time frame analysis. Because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames that we use? We use a minimum of 4 different time frames, and we call them as the high time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify our areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes, like fine-tuning the zone, different kind of entries like your type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Now, minded, this table, which is on page number 31, is specifically for the NSE market, because this market is only open for about 6 hours and 15 minutes. But if you're trading markets which are open for longer durations, like you have your commodities, you have Forex, you have cryptocurrencies, or maybe some international markets, then you can refer to the table which is on page number 32. But since I'll be taking examples from NSE, I will be referring to this table. So I opted that I want to plan monthly income trades. So from this table, I got to know that as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly will be the higher time frame, which is used for curve analysis. Weekly will be the intermediate, used for trend analysis. Lower time frame is daily. That is where we get our SCTS from. SCTS stands for stop loss, entry, target, and size. And in case I need to use my refining time frame, then my refining time frame will be the 60 minutes chart. And the refining time frame can be used for multiple purposes, like fine tuning the zone, like I said, type 2, type 3 entries, or even if we want to apply some additional rules, that is also where this time frame can help us. So as soon as I'm done with my step number 1, now I have the clarity to what time frames I'll be using, plus what is going to be the purpose of each and every time frame. So can you see, when we started, we had no clarity what time frames I'll be using, but as soon as I made my decision, okay, this is the kind of trade I would like to take, I have the clarity to what time frames I'm using, plus I also have the clarity to what is the purpose of each and every time frame. So my challenge number 1 is taken care. Now the next challenge is, yes, I do know my time frames, but if I take example of NSE again, on NSE you have over 2000 companies listed. So humanly not possible that every day I sit and analyze 2000 companies to identify my opportunities. So what we need to do now is we need to have a process in place for selecting some scripts. So we need to have a process which can help me find a smaller list out of this very big list of symbols, right? Which is 2000 plus on NSE or whatever markets you're trading. So how do you get that small list? For this, we use certain computer programs which are called as scanners or screeners. So if you do a Google search, you'll be able to find n number of free scanner screeners, which are either based on conventional technical analysis or fundamental analysis. But the challenge is that if your scanner screeners are not in sync with demand supply methodology, you might have to go through a lot of symbols to identify your opportunities, or maybe even after going through a lot of symbols, you might not be able to find anything which has a quality zone where you can plan your trades. So to overcome this challenge, what I did was I created 2 custom built tools. One is called as the demand supply zone alerts. The other one is called as the demand supply zone screener. And these tools, they help us identify symbols or filter symbols based on demand supply trading methodology. So if you want to have in-depth understanding of it, we already have the walkthrough videos available on the product page. So when you'll click on these, it will take you to the product page. That is where you can watch the walkthrough videos. I'll also help you understand how you can access it from our website. So once you're on our website, you can see under services, we have trading view indicators. And you can see you have alerts and screener. You can click on subscribe now. Once you click on subscribe now, it will take you to the product page, and that is where the in-depth walkthrough videos are available. You can go through those videos to understand them better. But quickly, I'll brief you what these 2 tools they basically do. So if you talk about the alerts first, so here you can see that I've so as of now only the crypto market is live, and alerts, they only work during the live market, right? So always remember, alerts, they only work during the live market. So that is why, because the crypto market is only live as of now, I can only show you examples from crypto. So what I've done is, you can see in the alerts, I've given a list of about 20 symbols, right? And then I have, then I've also given my, other inputs, right? What kind of patterns I want to detect, right? How many candles I want in the basing, how should be the strength of the leg outside. So all these things you can customize, and now I have applied it to a 5 minutes chart. So what this alerts will basically do is, now it will monitor those 20 symbols during the live market, and as of now the markets are live. So as soon as we have a formation of a demand area or a supply area, it will notify me. Now how do I get that notification? If you have a free account on TradingView, you will get a notification as a table on the chart, because as of now we don't have any zones. So that is why you don't see any table here. But once the next 5 minutes starts, which will be in about another 2 minutes and 20 seconds, if there are any formation of demand and supply areas, a table will be displayed on the chart itself, which will tell you on which symbol we have a formation of a demand area or a supply area. Now, if you have a paid account on TradingView, you can also create your alerts. So here you can see this is how the alerts, they get triggered. And the last alert was at 11:15. You can see the alert was for ETH USD, ETH BTC, and Sol USD. So I'll just take the example, which is ETH USD. It tells us on ETH USD we have a drop-based drop. So if I go to ETH USD, you will see that we had a formation of a drop base drop. So this was about 5 minutes ago, and that is why this alert was triggered at 11:15. Currently, you can see we are at 11:19. So once this candle would have completed, this alert was generated at the starting of this candle. This alert would have generated, and now you can see we have already entered back into this area of supply, which is this drop base drop. But yes, again, you have to remember, just because we have a demand area or a supply area does not mean we can trade it blindly. We will always have to qualify them based on our trade plan, and only if they qualify, we can use those opportunities. So that is alerts that during the live market, as soon as you have a formation of a zone, it will notify you. Now, talking about screener, how does screener basically works? Now in screener, you can see here, I have given a list of about 15 symbols. And then I have given my input as that for my proximity, I want my proximity to be 2%. So what this basically means. Now, the first thing you have to remember is that for the screener, it is not required the market to be live. Screener will work irrespective whether the market is live or the market is closed. But what screener basically does is it is not updating you when these zones are getting formed. It is updating you when we are getting closer to the zone. And that is why I gave that proximity setting as 2%, that out of these 15 symbols, on whichever symbol I am within 2% to a demand area or a supply area, shortlist for me. And now you can see it has shortlisted HCL Tech. Now just assume if I was doing my analysis manually, I would have had to go through all the 15 symbols just to realize this is the only symbol where I'm getting closer to a demand area or a supply area. So in a way, it saved me a lot of time, because now I don't have to analyze the other 14, because I know these are not closer to demand areas or supply areas. This is the only one which is close to demand and supply. So let me see if this particular symbol qualifies based on my trade plan. So if I go to HCL Tech, let's go to stocks. So you can see we have a demand area and the current candle is pretty close to it, and that is why it got shortlisted for us. So that is the difference between the two. Scanner will help you, the screener will help you symbols where you are getting closer to demand areas or supply areas, or already trading inside demand or supply areas. So you can also see that at now 11:20, because the 5 minutes have completed, we got some alerts. So just as an example, if I go back here, you will also see that we'll have that updated table. By the time the table updates, you can see we have zone formation on quite a few symbols. We have VTH USDT, we have Sol USDT, we have BTC USDT, and these are all drop-based rallies, which were formed. And because I'm on a smaller time frame, it will take few seconds for the chart to, for the table to load. But that's how the two tools, they basically work. Again, alerts will tell you at the time of formation of the zone, and screener will help you identify at the time of prices coming back to the zone. So can you see it gave you the list of all the symbols where you have formation of demand and supply areas. Just perfect. So again, step number 2 is to get a smaller list. Now how you get that small list, it's completely your choice. Like I already said, if you do a Google search, you'll be able to find a number of free scanner screeners which are based on conventional technical analysis or fundamental analysis. If you want something which is purely based on demand and supply, then these two tools are available. Process can be as simple as, because I want a small list, maybe I just want to analyze my Nifty 50 stocks, or maybe I have my own favorite list of symbols which I want to analyze every day. So choice is yours how you want to get that small list. But definitely the more the process is in sync with demand supply, the higher is the probability you might be able to find something which is in sync with your trade plan. So let's assume we got a list. Now, very, very important. Always remember, irrespective what scanner or screener you're using, whatever results you get from these scanner screeners, you can never blindly buy or sell those symbols. So the scanner screeners, they never tell you what you need to buy or sell. They only help you get a smaller list out of a big list. Now, once you have that small list, you will have to analyze them manually one by one and see which one matches with your trade plan. The one that matches with your trade plan might be an opportunity for you. The one which doesn't match with your trade plan, you simply ignore it. And that is how you identify your opportunities. So let's assume we got a list, and in that list, the very first one was ABC. So what am I supposed to do now? On ABC, I need to go to the lower time frame. So now the question is, what is my lower time frame? We got the answer from our step number 1, that as a monthly income trader, my lower time frame will be the daily chart. And on the daily chart, I need to identify a zone. And by zone, we mean any of these 4 structures. It can be a drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. Now, the biggest challenge with demand supply methodology is to identify the zones, because it takes a while before your eyes they start getting trained to identify these structures of demand and supply. So to overcome this challenge, we have also created a custom built indicator, which is called as the demand supply zone indicator, which automates this process, which means you no longer have to identify these demand and supply areas. The indicator does this automatically for us. And we also offer a 100% free 7 days trial of this indicator so that you can try it out if you wish to. Now, how can you get access to the trial? Let me just quickly help you with that, and then we'll start with our analysis. So once you visit our website, under services, you'll go to TradingView indicators, and you can see the first one is the demand supply zone indicator. Click on it, and you will be able to find this button which says 7 days free trial. Now it's a very small form which you need to fill. You just have to provide your full name, your email address, and your TradingView username. Now, just in case you don't have a TradingView account, you can click here and you can create a free TradingView account, because the indicator also works on a free TradingView account. So once you create your account, identify your TradingView username and put your TradingView username in this column. And similarly, if you already have a TradingView account, you can click here. You can visit your TradingView profile, identify your TradingView username, because it is very, very important that when you're filling this form, you are providing your correct TradingView username, because if you have provided an incorrect TradingView username, it will not get activated for you. It will get activated for the person to whom that particular ID belongs to, right? So do ensure that you are giving your correct TradingView username here. Then you'll get to know on which date your trial will expire and how did you hear about us. Just choose the relevant option here. Click on I'm not a robot and click on finish and start your free trial. And once you fill this form, within 24 hours, it will get activated for you. And once it gets activated, you'll get a notification on TradingView itself that now you have access to the indicator, and then you can try it out for free for 7 days. So again, because on this chart, so let's assume that's the symbol which was shortlisted for us based on whatever process I was using. And I have applied the indicator. You can see the indicator has by default identified our areas of demand and supply. So if you look at the very first one, this is a drop based rally, right? And most probably, if you will do the analysis of this, this will not get qualified based on the pivot and no authentic rules, right? Even though we are inside of it, it most probably will not get qualified based on pivot and or authentic rules. So that is the reason I'll be skipping this, and I'll be moving on to the next fresh area of demand, which is again a drop based rally. So if I talk about where is my nearest and fresh area of demand, this is my nearest and fresh, which is a drop based rally. So let's draw the zone. So my step number 3, which was to identify the zone. Do we have a zone available? The answer is yes. You can see the indicator by default has identified the areas of demand, and it has also plotted the area of demand for us. So yes, we had to identify a zone. Do we have a zone available? The answer is yes. Now, once we have identified the zone, does not mean we'll blindly trade it. The next step is to qualify it, which is a 2-step process. In step 1, we'll qualify it based on certain conditions, and in step 2, we'll qualify based on the booster scoring. So the first condition we'll check is that can this zone be a case of level on top of level? Now, why do we start with level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different area. So that is why we always first check, do we have to make any shift? Now, how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which we call as a coinciding level. So if we have a coinciding level, there is a possibility that it might be a case of level on top of level. But if it is not a coinciding level, it cannot be a case of level on top of level. So let's verify the zone which I have identified. Does it coincide with any intermediate time frame zone? And the best part about this indicator is that, it can automate everything for you, which is your curve analysis, your zone violation analysis. So here you can see I've already selected that I want my automatic settings for the HTF, ITF, and the RTF. And I've also defined my HTF is the monthly chart, my intermediate is the weekly, and my refining time frame is 60, so that when I go to these time frames, the applicable settings, they get applied automatically. So if I go to the weekly, you can see here it is identifying my weekly zone, which is a drop based rally. So let me mark this weekly zone with a different color, right? So this time I'll use a different color to mark it. So the one in pink, is my intermediate time frame zone, and the one in green is my lower time frame zone. So is my lower time frame zone inside my intermediate time frame zone? The answer is yes, and that is what we call as a coinciding level. So if I go back here, you can see this is my lower time frame zone and this is my intermediate time frame zone. So we do have a coinciding level. Now, since we have a coinciding level, now we'll double check, do we have one zone or do we have multiple zones? Now remember, in case of level on top of level, it is not mandatory that the other zones might be quality zones. So what I'll do is, I'll change my settings to all demand supply structures. And what you can see here now is that inside of the zone, we don't have just one, we have three different zones. So again, this is my intermediate time frame zone, which is getting divided into 1, 2, and 3. Can you see it is getting divided into multiple zones? So the rule for level on top of level was when the intermediate time frame zone gets divided into multiple zones on the lower time frame, and can you see it is getting divided into multiple zones, in fact 3 different zones. So now what I should be doing is, to have the maximum probability stacked in my favor, I should be using the lowest zone. So even though we started with this fresh area, we will be switching to the lowest one. So that is what we'll do now. We will switch to this one. And let me change the color to demand. And let's see if I'm using the correct areas. Perfect. So we started with the very first one, which was a fresh area, but now we are down to this zone, which is a tested zone. But now you will say, then why are you using a tested zone? We'll look into it as we move forward. But yes, as of now, this is the zone we will be going for because that's the lowest one in case of the level on top of level. So let's disable this now. Perfect. So yes, we looked into the very first condition. It was a case of level on top of level. Whatever modifications were required, we have made those modifications. Now this zone is not because of a gap, therefore gap rules will not apply. Now it is a drop-based rally structure to which we should be applying the rules of pivot and non-authenticity, right? So that's the first thing. But if I go to the rule book, you will see that there is an exception, and that exception says that in case of level on top of level, there is no need to apply the pivot or non-authentic rules, as being a case of level on top of level by default adds that extra probability we are looking for, right? So yes, even though it is a structure of pivot and authentic zone, this rule will not be applicable. Unstable equilibrium is also not applicable. So after applying all the applicable rules, is the zone qualified? The answer is yes, because it did not get disqualified due to any of these conditions. So we do have a qualified zone available to us. And since we have a qualified zone, now we can move ahead and start applying our boosters. So just give me a second. We'll apply the boosters to this one. So if we start with the boosters, the very first one is freshness. Now, if I again change these settings to all demand supply structures, you can see that this zone is already tested. So for a tested zone, I'll give it a score of 1.5 because it has been tested once, not multiple number of times. Talking about the strength, this is not even an explosive move, right? Not even a follow-through pattern. So I'll give it a score of 0 for now. Talking about time at the zone, we have 4 candles in the basing, and 4 candles in the basing will get a score of 1. And reward to risk ratio will take it as an assumption because based on the arrival, the reward to risk ratio can change. But with that assumption, we'll give it a score of 3. So if you talk about this zone, it is a low quality zone. So the question here would be, why am I using a low quality zone? And the answer is right there in your rule book. So if I go to the rule book, you can see in the rule book, we have page 107. There are certain characteristics of cases of level on top of level. Now mind it, these characteristics might not be applicable every time in case of level on top of level, and it is not mandatory that even if they are getting applied, all 3 of them will get applied. At times 1 of them might be applicable, at times 2 of them might be applicable, at times maybe all 3 of them might be applicable, and maybe at times none of them might be applicable. So the characteristics are, in case of demand, the lower zone might be tested by the upper zone. That is what we saw. When you go back, you can see the lower zone was formed and then it was tested and the upper zone was formed. So that is exactly what we can see here, and this is one of the characteristic of cases of level on top of level. The second characteristic is, in case of demand, the lower zone might be lesser strength versus the upper zone. That is also what we can see here. The upper zones, they have better strength. The lower one has a weaker strength. And in case of demand, the lower zone might have more number of candles versus the upper zone. That is also what you can see. This has about 4 candles, but this only has 1. This only has 2. So all the three characteristics are applicable here. So what you need to understand is that level on top of level basically implies that I'm still trading the intermediate time frame zone, but because that zone got converted into or got divided into multiple zones on the lower time frame, so what we are basically doing is we are just fine tuning that zone on the lower time frame and trading that zone. So that is why if you see the above said characteristics, right, if you see any of those characteristics can be ignored and the zone can be rated based on the intermediate time frame. So what we need to do now is, if we go back to our boosters, the ones which already have the highest score, right, we will not be making any modifications. But if we can upgrade the scoring of any of these, we will try to upgrade, but never downgrade, right? So we will see, can we upgrade any of these, because this we are already taking as an assumption, and for the other three, can we upgrade based on the intermediate time frame. So if I go to the intermediate time frame, the first thing you can see is, if you talk about freshness, once the intermediate time frame zone was formed, it has never been tested. So freshness, which was a score of 1.5, now we can upgrade it to a score of 3. Why? Because on the intermediate, it is a fresh zone. The next thing is strength, and here you can see we have an explosive move for the leg out. So what I can also do is I can upgrade it to a score of 2. And talking about the time at the zone, here also we have 1 2 3 1 2 3 4 5, right? So again, the score will remain the same. And again, even if it was, let's say, even more than 5, we would never downgrade. Like I said, we are only trying to upgrade the scoring. So this will remain as 1. This will not be downgraded even if the number of candles were more. So if you look at the overall scoring, can you see a low quality zone now got converted into a high quality zone because of the rule that we had in the rule book, which is right here, the characteristics of cases of level on top of level. You can see, even though we started with a low quality zone, we were able to convert the scoring to a high quality because of the case of level on top of level. All right, so now that we have applied the quality boosters, let's apply the probability boosters. So just give me a minute. Let me also draw my lines here. So let's go for the probability. The first one is location. Let's go back to all of this. Location, we'll check on the monthly. So you can see we have our monthly supply, we have our monthly demand, and we are planning our trade inside of that monthly demand. Now, generally, if the higher time frame supply zones and demand zones are pretty close by, generally I would wait for any one of them to get violated and then plan the trade, because if they are very close by, what might happen is you might not have a lot of room for the prices to move. But what you can see here is that even if you're looking at a 3:1 or a 4:1, we are still inside of that monthly demand. So price does not have to leave the zone to give us our required RR. It can still be inside the zone and give us our required RR. So that is why it is still perfectly fine. But if let's say my 2:1 was falling outside or maybe inside of this supply, then probably it would have been a better idea to skip the symbol and go to another symbol. But here you can see, even if you're looking for a 4:1, maybe 5:1, 6:1, 7:1, you're still inside that monthly demand area, which is perfectly fine for us. So yes, our location is the best location, gets a score of 2. Now at best locations, trends, they become irrelevant. It doesn't matter whether we are in an uptrend, downtrend, or sideways. All three of them can be traded with a score of 1. But if you go to the intermediate time frame, you will see the indicator will automatically do the analysis for you. It is telling us currently we are in sideways, which is perfectly fine. But like I said, at best locations, even in a downtrend, you can plan a long trade. So this will be a score of 1. Move from the zone, you can see we already have a move which is more than 4:1, gets a score of 2. It is a case of level on top of level. It is also coinciding. Now talking about trap becomes irrelevant because we already have a type 1 trade. So whether it gets a 0 or a 1, nothing will change. But what I can do is I can take a horizontal line just to verify. And I'll start pushing it up, trying to find an area where prices have been bouncing over and over again. So if you look at just this area above our zone, you can see in the recent past, beautifully worked like resistance, beautifully worked like support, almost support. Here also you can say almost acting like support, acting like resistance. So we do have a pretty clean area of support and resistance, and our zone is sitting right below it. So it has that probability that it might work like a trap. So we'll give it a score of 1. So if you look at the overall scoring, we have a score of 9 for quality, which makes it as a high quality zone, and 8 for probability, which makes it as a high probability zone, and high quality, high probability can be done as a type 1 trade. So going back, this is going to be a type 1 trade for us. Now, no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So we need to be ready for the worst case scenario, for which we'll do a proper position size calculation. Now, whenever the prices are back, the way we just qualified the zone will again re-verify that does it still qualify based on our trade plan. The reason is the markets are not static, markets are dynamic, conditions are changing almost every other second. So every time you're about to place your order, before placing your order, you'll double check that does it still qualify based on my trade plan. If the answer is yes, you place your order based on the entry type, in this case a type 1 trade. And once your order has been executed, the last step is your trade management, where 1:1 we make it as a break even trade. That's your step 1. And after that, if we get the opportunity to trail onto it, we start trailing it. And that is how we plan our trades in a very mechanical and rule based way. Now, these sessions are helping you plan better trades. Then do like the video. If you're not subscribed to my channel, do subscribe to it. And the most important part, I'm pretty sure you people also understand, a lot of people who trade are struggling with trading. So if you have any friends, family members who are into trading, or if you're part of some trading group, then do share the link to my course content, link to these live sessions, link to the free trial of the demand and supply zone indicator, so that more and more people can take advantage of it. And again, all the content we just talked about is 100% free. So the more you spread the word, the more number of people can take advantage of it. Now, at the end of the session, what I do is I take your questions, queries. But before I do that, let me also add feedback, which I was getting from you people was, yes, you do take the questions, queries at the end of the session. But what if I don't want to ask my questions publicly? Or what if I want to share my analysis, which cannot be done in the YouTube chat? So there is an option for it. Once you visit our website, you can see on the top right corner, you have this option which says 1-to-1. So you can always click on it. And here you have the option to schedule a 1-to-1 appointment. There are two kind of appointments you can schedule. One is a telephonic call. If you feel that on a phone call you can ask your questions, you can get answers to it, you can go for a phone call. And if you feel that you want to share your analysis, then you can go for an online meeting where you can share your screen, you can share your analysis with me, and I can help you with that. All right, so that being said, let's get back and see what questions, queries we have in today's chat box. Do we have to use only quality zones for the curve analysis? Okay, so let's take questions one by one. So do we have to use only quality zones for the curve analysis? The fact is, for curve analysis, it is not required only to go for quality zones. But again, different people, different personality styles. Now, very simple example. Let's say if I'm planning an HIT trade. As an HIT trader, what I would like to do is maybe I want to be extra conservative, and that is why I only want to go with quality zones even for my curve analysis acceptable, right? So again, it all depends how aggressively or how conservatively you want to plan your trades. But if you think about it, when it comes to irrespective of whether it is HIT, DIT, WIT, the zones which we are using on the higher time frame, that is not where we are taking the trades. We are only trying to understand where we are on the demand supply curve. So that is why it is not required to go for quality zones. But yes, if you wish to, that's completely your choice, but otherwise it's not required. Even for an HIT, I would prefer only to go for a fresh areas, not quality areas. If you talk about when I do the analysis, you will see that for MITs, I also use tested areas, but for an HIT, I will never use a tested area. So quality is not required. Freshness is maybe something you can give more importance to when it comes to your curve analysis. Do we have to use only fresh for curve analysis? So I've just answered that. So quality, maybe you can skip. Freshness, yes, maybe you can give a little extra weightage. Can we use tested zone in intermediate time frame for quality scoring like LOTL? See, if you look at today's example, when we went to the intermediate time frame, because it was fresh, we gave the scoring based on fresh, right? But in case of level on top of level, if the zone was already tested, then I would say it would have been a better idea to avoid the trade altogether, because now the zone is also tested on the lower time frame, the zone is also tested on the intermediate time frame. Makes more sense skipping it versus still planning your trade. But yes, let's say if you're a little aggressive trader and you see that the intermediate time frame zone is already tested, yes, you can lower the score and you can still plan your trade based on that if you wish to, right? Ideally, if I would have seen the zone already tested on the intermediate time frame, I would have skipped it. All right, so let's see. All right, can we use for 24/7 markets Okay, so if the markets are 24/7 like cryptos, then I told you the other table which is available on page number 32. I guess it's on page number 31 or 32. Let me do this. Let's go to 28 first. It will be easier. So this is the one you can look into. So if you are trading markets which are trading 24 hours, you can look into this table which is on page number 32 for your time frames, right? So that is what you can use. So that answers your query. Is it okay to just concentrate on type 1 trades, ignore type 2, type 3? One has a very busy schedule, can only manage first hour. See, definitely. In fact, what you will realize is that eventually, even if you're trying to plan type 2, type 3 trades, the number of fills you will get will be very few because the conditions we are waiting for at times, even before the conditions they happen, price, they already leave the zone. So eventually, you will see most of the traders, they start shifting to type 1 trades. In fact, if I talk about my trades, 100% of my trades are always type 1. I never do type 2 or type 3. And again, if you're doing type 1, it also helps you plan your trades as set and forget trades. Like you already said that you are busy maybe during the day. But yes, if you are doing type 2, type 3 trades, then you need to be in front of the computer. If you're doing type 1 trades, you can always place a bracket order with your entry, with your stop loss and your target. And the bracket order takes care of itself, right? So that also gives you the advantage of doing type 1 trades, that your trades can be purely done as set and forget trades, provided they are qualified when the prices are about to enter the zone. All right. Are this indicator free? So if you talk about the demand supply zone indicator, we are providing a 7-day free trial, but after 7 days, if you want to use the indicator, you'll have to subscribe to it, right? But we do have the free version also available, but the free version will only work on the daily time frame. So that is the only limitation there. Can we use 24/7 market? So I just answered that question with the time frames you can use. I've seen the page 32, but can the time frames be used? Okay, so you're going for some different time frames. Let's see. But you haven't mentioned for what purpose of trade, right? You've only given your time frames, but not for what purpose of trade. In fact, to make it much more easier, let me simplify it for you, right? So if I go back here, see, whenever we are deciding our time frames, what you need to take care of is that when you're shifting from one time frame to another, it should be a multiple which is somewhere from 3 times to 6 times. Now, what do I mean by that? You see, from 1 minute chart, where I'm going to the 5 minute chart, it's a multiple of 5. If I multiply this by 3, it's the 15 minutes chart. If I multiply by 4, it's my 60 minutes chart. If I multiply by 6, because I'm talking about NSE, which is only open for about 6 hours, that's my daily chart. Daily multiplied by 5 is my weekly, and weekly multiplied by 4 is my monthly. So what you can see is that whenever we are shifting from one time frame to another, the jump is from 3 times to 6 times, right? We are not doing anything less than 3. We are not doing anything more than 6. So similarly, here also you can see exactly the same thing. From 60, I multiply by 5, I get my 240. Right, so 240 is 4 hours, and if we multiply by 4 6er, right, is 24. That is your daily. Again, daily multiplied by 5 is your weekly, and weekly multiplied by 4 is your monthly. So that is the only thing you need to take into consideration, that whenever I'm using my time frames, it should not be that from a 5 minute chart I'm going to a, let's say, a 7 minute chart or a 10 minute chart, because that will only be a multiple of 2 times or maybe even less than 2. So as long as you're taking that into consideration, you can choose any time frames, and it should also not be something like this, that from 5 I'm going straight away to a 60-minute chart, which is now a multiple of 12 times, right? So as long as you're within that range, 3 times to 6 times, you can always define your time frames based on your preference. All right. I'm using demand supply of yours. Want to use a screener too? Please guide for the same. So see, if you want to use the screener, you need to subscribe to it. But what you mean here is that you already have your subscription for the demand supply zone indicator. Now you also need the screener. In that case, what you can do is you can send an email to info@surjit telling them that you already have the demand supply zone indicator, but now you wish to also have access to the screener. So what we'll do is whatever is the balance amount for your demand supply zone subscription, will give you a coupon which will be in equivalent terms based on pro rata basis, right? And when you're subscribing to the screener, that is the time you can use that coupon to adjust the balance amount, and you can pay the rest, and you will be able to upgrade to the screener, because with screener by default you get complimentary access to the demand supply zone indicator during your screener subscription period. So that is what can be done. Can you please give an update on video and indicator overview? I'm confused about how to customize settings for HID trades, like the section where we have to enter time frames, intermediate, HDF. So again, I'll just quickly tell you what you need to do here. So let's say if I'm planning HIT trades, right? So for HIT trades, what I'll do is I'll take my time frames. So for an HIT trade, my high time frame will become 60. So here you can see how your time frames have to be inputted, right? So if you're going for minutes, it has to be from 1 to 1440, right? So if I want to give it as 60 minutes, I'll only give it as 60. My intermediate now will be 15 minutes chart. I can give it as 15. Lower time frame is 5. Here you don't have to define your lower time frame, and refining will be your 1 minute chart. Now, because I am doing HIT trade, so probably I would like to have fresh zones for my curve analysis. I can check mark this. And for the intermediate violation, we use all zones. For refining time frame, we use all zones. And now my indicator is set based on the HIT trade setups, right? So that is all you have to do. But how to provide your time frames correctly, you can just hover over this and it will tell you how to input your time frames, right? For daily, you have to give from 1D to whatever number of days. Similarly, for weekly, it has to be 1W to 52W. For monthly, it has to be 1M to 12M. And for the minutes, it just has to be from just the numerical value, right? So that is how you'll do it. Perfect. So that answers your query. And that brings us to the end of today's session. Thank you everyone for joining in. I will be seeing you now next weekend. Until then, trade safe. Enjoy your Sunday. Take care. Bye-bye.